Hello and welcome to our program, everyone. I'm your host, Caitlin Cormier. The year 2022 will likely be one that many investors would like to forget. There was a lot of turbulence across major markets around the world, and there could be more ahead in 2023. So some investors may be searching for new ways to help protect their portfolios or perhaps even outperform the broader market. Well, there are many ways out there that the investor could consider, and today we're going to focus on one that's worked well for our guest speaker. It's called Beat the TSX, and it's a method of selecting Canadian dividend stocks. The strategy has outperformed the benchmark TSX 60 index over the past 30 years. Now, it's important to remember that past performance is not indicative of future returns. That said, the criteria may offer perspective to investors figuring out the criteria that works for them. Here to tell us more about it is Matt Poyner, founder of the blog Dividend Strategy. He writes extensively about the Beat the TSX strategy and tracks historical data related to it. Matt, thanks so much for taking the time to chat.
My pleasure, Caitlin. Thanks.
Really happy to have you here and very interested to hear more about this strategy. So let's start off and ask, so how did you discover the Beat the TSX strategy?
Well, my background, my professional training is actually as a physician, which is a little bit of an unusual entry point into the world of personal finance and investing. But I've actually found that it's prepared me really well for this world because the way that we're trained in medical school right off the bat is in something called evidence-based medicine. So what that means is that it's not you're not going to get the best outcomes for your patients if you base your decisions on what feels right or tradition. You really need to base your decisions on science. And so we're trained right from the get-go to go out there and gather the necessary information, filter the good from the bad, process it, analyze it, and then use it to make pretty complicated decisions in uncertain situations. And it's pretty much exactly the skill set and mindset that I think you need to be a good investor as well. As I was trying my best to manage our money, I was going out and reading books, and I subscribed to a little Canadian magazine called the Canadian Money Saver. And every year they had this article that was written about this very simple method of selecting Canadian dividend paying stocks called Beating the TSX. And it really appealed to me because it was truly evidence-based. It wasn't somebody's opinion. It wasn't somebody trying to predict what stocks are going to do. It was a very simple, easy-to-follow method that even I could understand as an amateur investor, and it had the data to back it up. When I came across it, it already had about 15 years of data that showed that this simple method had in fact been beating the TSX. It seemed obvious to me that this information should be available to everybody all the time for free, and the way to do that is with a website. And so that's when I started dividendstrategy.ca. It gave me a platform to explain the method, make it available for people as a tool, but also a platform for me to write about other things that I think are interesting and relevant for Canadian DIY investors.
Everything's like full circle. You started just finding out about it, and then all of a sudden you own it. So that's very cool. I also like the parallel that you draw between medicine and investing, taking the emotion out of it and just really looking at the hard facts and making your decisions. That's a very good way. We tend to get so emotional when it comes to investing, so I love that. That's kind of part of the strategy, is taking that emotional part out of it. Okay, we may have some skeptics out there, so we're definitely going to get into it. We're going to go through the pros, we're going to go through the cons, really kind of get into it. But before we do, I know that you are a big proponent of the Beat the TSX strategy, but someone else actually invented it. As you said, you only kind of came into it around 15 years in. So that's going to be my trivia question for our audience. Who invented the Beat the TSX strategy? So we're going to reveal the answer at the end of our conversation, so stay tuned for that. So, of course, we want to know the proof is in the pudding. What sort of results have you seen from this strategy before we get too deep into it?
So as of the end of 2021, over the last 30 years, Beating the TSX has had an average annual return of about 13%. versus about 10.5% for the benchmark TSX 60 index. So that's pretty significant. Updating those numbers, given that we've had kind of a rough year in the stock markets this year, now the 30-year returns are something around 12.2% for beating the TSX versus about 9.8% for the TSX 60 index. And by the way, those numbers are total returns, so capital gains plus dividends. One of the things when I do the annual number crunching to look at what the performance has been is I go back over various time periods. So how has it performed not just over the last year, but over the last 3 years, 5 years, 10 years, 20 years, and 30 years. And it doesn't always work out this way, but as of the end of 2021, in each one of those time periods, beating the TSX has managed to outperform the underlying index. So it's pretty impressive, even to me. Now, that can be deceiving. Now, some people see those numbers and they just want to jump in with both feet. So it is important to realize that there are periods of underperformance. Any good investment strategy is always going to have periods of underperformance, and beating the TSX included. But over the long run, another way that I illustrate how beneficial beating the TSX has been in the past is that if you had invested $10,000 right at the beginning of when we started recording data back in 1987, if you'd invested $10,000 in beating the TSX versus the benchmark index, by now you would have about $340,000 utilizing the beating the TSX method versus about $160,000 just investing in the benchmark TSX 60. So that relatively small, maybe 2.5%, 3% average annual outperformance really does compound over long time periods.
Okay. Let's get right down. Let's talk about what this strategy is. So first off, how does the Beat the TSX strategy work?
The method is really simple. It's 3 steps. Step 1 is you have a look at our benchmark index, which is our TSX 60, and you organize the stocks in the TSX 60 by dividend yield, highest to lowest. And then step number 2 is you would purchase, this is the method, you purchase hypothetically the top 10 dividend yielding stocks of the TSX 60 in equal dollar amounts and hold them for a year. And then step 3 is that at the end of the year, those stocks would theoretically get sold, and then you would rebuy the next portfolio of the top 10 dividend paying stocks. So that's the method, and it's very important to me to be as scientific about this as possible and consistent and transparent as possible. So that method doesn't change year over year. We use the same method, and I think I do that very purposely so that we can have as much faith as possible in the results. Beating the TSX is really meant to be used as a tool to identify potential dividend paying stocks that people might want to include in their own portfolio. Some people, including myself, when I first came across it, I really did follow it like it was a recipe. I used it as it was step by step, and I built my portfolio around that. But as time has gone on, and this happens with a lot of people who I've come across who use beating the TSX as a tool, I've kind of evolved, and I use it more as a tool to select potential investments and not necessarily as a black and white recipe book to build my portfolio.
Okay, so what are some potential advantages with this strategy? So we're taking this method, we're putting it into place. What are some advantages of this process?
One of the biggest strengths of the Beating the TSX method is that it doesn't depend on mine or anybody else's predictions or opinions. It's really rules-based. The other thing that goes along with that is that it's simple. Not only is it rules-based, but these are rules that anybody can understand and anybody can implement. And because it's so simple, it also tends to be low cost. You don't need to pay an MER for somebody else to manage your money in a mutual fund, for example. And there's at least the way that I would suggest most people employ it would be with an annual rebalancing. There's very little trading involved, so their trading costs are low, and it also doesn't take much time. So those are some really big advantages to the strategy. And of course, the big advantage to the strategy is there's the potential for higher returns. Now, that seems to be what's happened in the past. I don't know if that's going to continue necessarily, but I do think that there's a lot of reasons to believe that that it may very well continue along the same trajectory.
And what about the other side of the coin? So what are the potential disadvantages?
So I think the biggest and most obvious potential disadvantage of beating the TSX is that it's really under diversified. The type of stocks that end up in the top 10 dividend payers of the TSX 60 tend to be concentrated in just a couple of sectors: financials, utilities, energy stocks, and telecoms. I think another disadvantage potentially is really emotional or psychological. When you look at the list of beating the TSX stocks, because it is a portfolio that's based on dividend yield is just the dividend divided by the stock price. So if the stock price is depressed, then the yield goes up and the company may arrive on our list. And the stock price may be depressed for a reason. Well, they're always depressed for a reason. That the company might have fallen out of favor with investors. And so sometimes it can be scary to buy those kinds of stocks for people. And so I think that in order to employ the beating the TSX method or strategy for yourself, you do need to have a little bit of a contrarian streak. You need to be comfortable doing what other people are uncomfortable with. Because the fact is, some of those companies, many of them are going to bounce back, but some of them don't. And that's just a characteristic of this method. And then the last potential disadvantage is that I think you need to be prepared for periods of underperformance. Beating the TSX does not always beat the index. It has on average, but there are going to be periods of times when it doesn't. For example, I wasn't invested in beating the TSX in 2005, 2006, 2007, but those were 3 years in a row where it actually underperformed the index. And so it can be very, very difficult to stick with the strategy through those hard times. You really need to have gone into it with your eyes open and stick with your plan. Because if you had stuck with your plan at that time, you really would have been very well rewarded for your patience and diligence.
Okay, thanks for running us through the basics of the Beat the TSX strategy, Matt. Now, I want to take a moment to show our audience how they can look up stocks that meet the criteria in WebBroker.
We're going to click on Research. Underneath Markets, we're going to go to Indices. This will bring up kind of our overview of indices page, and we're going to focus on the left-hand side here where it shows all these major indices, and we're just going to scroll down and click the S&P TSX 60. It's going to pop up this little chart here, and we're going to click on Members to get the full listing of stocks that are included in the S&P TSX 60. Once we're here, we're going to go ahead and rearrange these stocks based on dividend yield, that important criteria for this particular strategy or method. We're going to click dividend yield, and it's going to automatically rearrange these stocks from highest dividend yield to lowest dividend yield. So right there, that easily we can find out what the top 10 dividend yield stocks are on the S&P TSX 60. Now, of course, we're going to want to do some further research on these individual stocks to see if they might be something we'd want to be interested in investing in. So what we're going to do is we're just going to go ahead and click on one of these securities, and we're going to click down here on the overview. Now, this page is where we kind of house all the information about individual securities within WebBroker. On the top, we have information about the price. As we scroll down, there's lots of reports and news available. Fundamental information's over here, including that dividend information like the annual dividend rate, ex-dividend, and pay dates. If we click on fundamentals, that will actually take us in and allow us to see a comparison for this company to other companies on different fundamental information. So it's industry comparison, so the industry average, or we can click on peer comparison and see that company versus its peers and how its results compare. Finally, we'll look at charts as well. So charts not only will allow us to see kind of the price history for this particular stock, but we may also want to add the dividend yield as one of our lower indicators. So we're just going to click lower indicator dividend yield, and then that will show right below the chart how that dividend yield has fluctuated over time. So again, just another piece of information to help us research these Beat the TSX stocks a little bit further.
Okay, hopefully that demo helps our audience understand how they can start researching stocks that might be a part of the Beat the TSX strategy. So thinking of history, thinking of this year, thinking of the years to come, what we're talking about as far as the economy and markets, as far as projections, have you seen the Beat the TSX strategy perform during bear markets like the type that we've experienced in 2022?
Great question, because those historical average returns that look so impressive, they're important, but the hardest times to stay invested are really during bear markets. And so I think that it's important to be able to have faith in your strategy, whatever it is, so that you can hold on through these hard times. So I actually did research into the Beating the TSX data right from the beginning. In order to really answer this question of like, how does Beating the TSX perform, or how has it performed anyway, in bear markets when it was the hardest for investors to potentially stay invested? And so what I did is I looked back and I tried to identify the 3 worst years for the Canadian stock market. And then I analyzed how the Beating the TSX method performed in those years, in the year after, the 3 years after, and then 10 years after as well. So I think it was the next year, 3 years, 5 years, and 10 years after. And what I found was that in those years where the stock market had dropped the worst bear markets, TSX provided a buffer. On average, the Beating the TSX strategy had outperformed the benchmark index by about 5% in the year of the bear market. And then in those subsequent time periods afterwards, 3, 5, and 10 years, similarly, Beating the TSX seemed to provide some protection by continuing to outperform the underlying index, with very, very few exceptions in the time periods after. That article I actually wrote before this past year, though. Looking at the numbers for this year, the TSX 60 index, as of a couple of days ago anyway, was down about 3% total return. And our Beating the TSX portfolio for 2022 was actually up about 6%. So this year as well does seem to be following that trend. This year so far we've got an outperformance of about 9%.
Okay, very good. Okay, so investment strategies ultimately boil down to risk versus reward. So how does Beat the TSX strategy compare to its broader index on that metric?
Yeah, I find this fascinating, Caitlin, because over the last 30 years, Beating the TSX portfolios have actually been a little bit more volatile than the TSX 60. That's not surprising at all, though, because our portfolios are only 10 stocks and the TSX 60 is 60 stocks. So as soon as you get that kind of concentration, you should expect there to be somewhat more volatility. But as we've already talked about, Beating the TSX has also had higher average returns. And so we need to find a way to figure out if it's worth it. Because if you have portfolio A and portfolio B, and portfolio B has slightly better returns but is way more volatile, then the average investor might be better off actually choosing portfolio A. So I don't mean to get too technical here, but I think that this is fascinating and useful. The way that we try to answer this question as to whether portfolio A is worth it is by looking at something called risk-adjusted returns. And so there's another well-known metric that can be used called the Sortino ratio, which only looks at downside volatility. And it turns out that the Beating the TSX portfolio over the last 30 years has actually lower downside volatility than the underlying index. And so the Sortino ratio actually is calculated, once you calculate it, shows that Beating the TSX has a higher Sortino ratio than the underlying benchmark index, meaning that you actually get better risk-adjusted returns, or you have received better risk-adjusted returns using Beating the TSX over the last 30 years than investing in the underlying benchmark index. So this seems to really be a pretty fascinating exception to the rule that lower volatility automatically equals lower returns, and vice versa.
I like that. It's really important to distinguish when we talk about volatility. I mean, volatility obviously causes that roller coaster ride, but you're right. It's the downside that we're most concerned about. We don't tend to complain if our portfolio has really, really good returns. We're happy about that. But if it has really negative returns, then it's certainly the opposite. So very interesting. I love that you point out that ratio. That's a very, very interesting statistic. We talked a little bit about dividends. Dividend stability is also a very important thing. So how does dividend stability of the Beat the TSX stocks generally compare to the broader index?
Another great question, because this is one of the biggest challenges for dividend investors in particular, is trying to navigate the potential for dividend cuts. I wrote an article where I looked at the last 10 years of the Beating the TSX portfolio, and what I found is that over the last 10 years, about 73% of Beating the TSX companies have actually raised their dividend, not cut it, and the average raise is about 7% over that time frame. So that sounds pretty great. Only 6% of companies have cut their dividend. But the problem is that when a company cuts their dividend, the average cut was 66%. So the average raise was 70%, the average cut was 66%, which means that looking at the whole picture, the Beating the TSX portfolios had an average dividend growth rate that was a little bit lower than what I was expecting, to be honest with you. It had an average growth rate of only about 1.5% per year. So that's something that's very important to be aware of. And I think the reason why this happens is really because the method is selecting those stocks with a high, primarily based on yield, not on growth. And sometimes stocks will make their way into the top 10 spots because their price is depressed, which makes the yield go up. And a lot of those companies will be able to bounce back, but some of them don't. And so sometimes the yield is high because that dividend may not be sustainable. And that's one of the really big reasons why I really encourage people to use Beating the TSX as a tool to identify potential investments and not just blindly jump in and buy everything on there, because sometimes there are stocks on there that have not been able to sustain their dividend.
Dividend yields can fluctuate a lot during the year as the market moves. You kind of indicated that a bit. So why does the strategy suggest buying stocks less frequently?
Well, I think the biggest reason is really going back to the fact that the Beating the TSX method really revolves around an annual rebalancing, and that's really just a standard that's kind of pervasive throughout other funds and portfolios. We tend to calculate the annual rates of return, but even though that's inherent to the method, I actually also tend to think that it's actually a very useful way to put that portfolio into practice for an individual as well. And that's the beauty. One of the advantages to this system is that it really is not very time intensive. And as I think I mentioned before, the people who I come across and work with, they're really looking for a way to manage their investments that doesn't take a lot of time and energy and stress and anxiety. They want to build a portfolio that they can kind of set it and forget it and just spend a reasonable amount of time, maybe every year, maybe for some people it's every 6 months, probably for most people not more frequently than that, but they can just spend a couple of hours, say every year. That's what I do anyway, just to rebalance their portfolio.
You mentioned that Beat the TSX strategy should be treated more as a tool for consideration than an exact recipe to follow. So what is your approach to using it in your own portfolio?
So in terms of the way that I use Beating the TSX now, there's a couple of ways that I differ from the method that we've described. The first is that I don't always buy every stock that shows up on the list. I look at them individually because I've also been burned in the past by stocks that have cut their dividends. And so now I have a look and I make an assessment as to whether or not I think that dividend is going to be sustainable or not. And there's some companies that may not have a long dividend history. Particularly, I'm looking for stocks that have a history of not just paying dividends, but increasing those dividends over time. So that's the first thing. I don't necessarily buy every stock that's on the list. At the end of the year, I don't necessarily sell stocks that have fallen off the list, because usually stocks fall off the list not because they're bad investments, but simply because they're one of those stocks where the price has rebounded. And so they're still paying that dividend. They might have even increased that dividend, but the yield is lower simply because the stock price has increased. And so if that company still fits within my plan for our portfolio, then most of the time I'll hang on to it, because you never know, in the next year it might be back on the list anyway. So I want to decrease my frictional transaction costs. The third way is I usually but don't always buy the stocks in equal dollar amounts for the year. Sometimes there's a stock that I'm just a little less comfortable with than the other ones, and so maybe I'll buy half of it than the other ones. So that's just another thing that I do. But in terms of the overall picture of our portfolio, I don't use Beating the TSX as kind of the backbone of our portfolio, but it's certainly not the entirety of our portfolio. I buy other Canadian, primarily dividend-paying stocks that give us exposure to other sectors, which is important for Canadian diversification. And then I also use index ETFs to get exposure internationally, which is very important. I don't mind some home country bias, for sure. I think, a lot of Canadian companies do business internationally, and then there's also advantages, especially when you're receiving dividends, because of the eligible dividends have preferential tax treatment in Canada. So I don't mind some home bias, but I think it's very important to have international diversification within one's portfolio as well. So those are some of the ways that I use Beating the TSX personally.
Okay, that's good. It's so much wisdom and kind of perspective. I love that. That's so great for our listeners. I'm sure they found so much value. We are going to have to wrap our conversation there. Thank you so much for sharing your perspective on the Beat the TSX strategy, for all the hard work that you do crunching the numbers on the performance, all the articles that you write. I know there's a ton of people out there that are really appreciative for you doing all this heavy lifting for us, for sure. Before we say goodbye, let's reveal the answer to our trivia question. As a refresher, the question was, who invented Beat the TSX strategy? And the answer is David Stanley developed the Beat the TSX strategy. It is a Canadianized version of the Dogs of the Dow strategy developed by Michael O'Higgins, who wrote about it in his book, Beating the Dow. So, of course, you already knew that. You knew the history of this strategy in and out, right?
Yes, I feel very fortunate to be following in David Stanley's footsteps. I feel really honored to be the steward of this method that he really pioneered. David and I, we consider each other friends. I actually was just emailing him this morning. He's a wonderful guy. He's been an incredible resource for Canadian investors for years and years and years, and he's enjoying a very well-deserved retirement from this. I know he enjoys his time spending time with his dog, doing lots of gardening. But every now and then he will still feel inspired, and he'll write a little something for the blog. And I know I and the readers of dividendstrategy.ca always really enjoy his perspective and insights, because he's such a valuable resource.
That's so cool that you still have that good relationship where you kind of passed the torch along, and now you're carrying it. So that's very cool that you still have that good relationship. Thank you again for joining us. And for those of you in our audience, make sure to register for our upcoming live webinars and check out our library of on-demand content available in the Learning Center and on our YouTube page. See you all next time.